ever get that feeling? Like you're walking the financial tightrope and the wind's starting to pick up.
Yeah, that's a good way to put it.
Well, today's deep dive, we're definitely in that zone.
Yeah.
We're looking at some signals in the U.S. stock market,
Okay.
specifically the SPX index.
Go.
And they suggest maybe
Yeah.
we should all check our portfolio's safety harnesses, so to speak.
I like that analogy.
Expert speaker, what's got us walking this tightrope today?
Well, let's talk about the 10-year Treasury yield.
Okay, yeah.
This is basically the interest rate on U.S. government bonds.
Right.
Those super safe ones, you know.
Yeah, yeah.
And you can think of it kind of like a financial mood ring.
Okay, a mood ring.
And right now, that mood ring,
Yeah.
it's flashing a sort of cautionary yellow.
Oh, yeah.
It hit 4.449% today.
Wow.
And historically, at that level, it signals some potential storm clouds for the stock market.
So we're not saying run for the hills.
No, not a crash, but the chance of a pullback, meaning a drop in prices, definitely goes up when we see this number climb.
So it's not that we're about to fall off, but the wind's picking up a bit.
Exactly.
And you called this 10-year yield, what was it again? A mood ring for the market.
Yeah. It's a kind of a fun way to think about it.
Yeah, I like it.
But why does this particular number matter so much to stock investors?
Right. Like, why this one?
It all comes down to something called opportunity cost.
Okay.
Investors are always weighing their options.
Yeah, makes sense.
They're looking at the stock market, which,
Yeah,
potential for big gains,
sure.
but also more risk.
Of course.
And then they're looking at those steady, reliable government bonds.
Right.
And when that 10-year yield goes up,
Yeah.
those bonds start looking a little more tempting.
Okay.
It's like, hey, I can earn a decent return without the stress of the stock market roller coaster.
Right. That makes sense.
And when enough investors start thinking that way, they shift money out of stocks into those bonds.
Yeah.
And that can push stock prices down.
So the higher this yield climbs, the more tempting those bonds look, and more investors might be thinking about getting off that roller coaster.
Exactly.
But you mentioned this 4.449% specifically as a kind of a warning sign.
A little bit, yeah.
What makes that number, like, why is that the one?
Historically, when the 10-year yield crosses above 4.25%, stock market returns,
Yeah.
they get a bit less predictable.
Okay.
And the risk of a pullback increases.
So to be clear, a pullback,
Right.
not a crash. We're talking...
No, like a temporary dip
Okay.
in prices.
Okay.
But those dips,
Yeah.
they can be significant
Okay.
and definitely unnerving for investors.
Got it. So 4.25, that's kind of our first gust of wind on this tightrope walk.
I like that, yeah.
Not enough to knock us off, but
Right.
we're paying attention now.
Exactly.
And this all makes sense in terms of investors, thinking about those bonds. But you also mentioned something else.
Price to earnings ratio.
Yes.
So help me out here.
Okay.
What's the connection there?
Well, the PE ratio compares a company's stock price to its earnings.
Right.
And it's another important tool for understanding valuations in the stock market.
Okay.
But what's fascinating is that we can actually use this 10-year yield to calculate an ideal PE ratio for the whole market.
Wait, so we can use the interest rate on a government bond to figure out what the price to earnings ratio should be
You got
for a company or even the whole market.
For the market as a whole, yeah.
How does that even work?
It's surprisingly straightforward.
Okay.
You just divide one by the yield.
Okay.
So, for example, at a 4.5% yield,
Yeah.
the ideal PE ratio would be roughly 22.22.
Okay.
Meaning, given what you can get from those safe government bonds,
Right.
that PE ratio would make stocks equally attractive from a risk-reward perspective.
Okay, so if the yield is 4.5,
Yeah.
investors are expecting a PE around 22.22. Roughly, yeah.
To justify the risk of being in the stock market.
Exactly.
But the yield right now is a bit above that.
It is.
So what does that mean?
Well, that's where it gets even more interesting.
Okay.
The S&P 500, which, represents a big chunk of the U.S. market,
Yeah.
is currently at a PE of 22.2.
Oh, wow.
So essentially,
We're right on the edge.
we're right on the edge.
If that yield keeps climbing, that ideal PE goes down, making stocks look even riskier
Exactly.
in those safe bonds.
And if that yield hits, say, 5%,
Yeah.
that ideal PE drops to 20, putting even more pressure on stock prices.
Wow. Okay, this is all making sense, but there's something that's been bugging me a little bit.
Okay, what's that?
Don't interest rates and the stock market
right.
usually have an inverse relationship?
You're right, they do.
When rates go up, stocks go down, right?
That's the classic understanding.
But what you're describing sounds like they're moving in the same direction.
That's a great observation.
So the market's not playing by the rules right now.
Think of it less like breaking the rules and more like a market twist.
A twist.
In 2023, for example,
Yeah.
we actually saw a positive correlation
Wow.
between the 10-year yield and the stock market.
So when the yield climbed, so did stock prices.
That's what the data showed, yeah.
Okay, now I'm really confused. Why would that happen? It seems like the market just rewrote the script.
Well, it seems some other forces were at work,
Okay.
maybe overpowering that typical inverse relationship.
Like what kind of forces?
Think about things like overall market sentiment,
Okay.
how optimistic or pessimistic investors are feeling,
Right.
or the rate of inflation,
Yeah.
even what the Federal Reserve is doing.
So it's not just this one number,
Right.
the 10-year yield.
It's part of a bigger system.
It's the whole ecosystem.
Exactly.
All these different factors pushing and pulling. But how do we make sense of all of that? It's starting to feel like we're juggling chainsaws up here.
Don't worry, we're not going to leave you hanging.
Okay, good.
Let's break down these yield ranges a bit further
Yeah.
and see what they tell us about the risks and opportunities ahead.
I'm all ears.
Okay, so imagine we're looking at a map of this tightrope walk.
Okay, yeah.
Here's how we could divide it
Right.
between 3.25 and 4%.
Okay.
Think of this as the smooth sailing zone.
Okay. I like that.
Historically, the market performs pretty well within this range.
Okay.
Solid returns,
Yeah.
relatively low volatility.
Okay, nice.
Now, between 4.25 and 4.5%,
Okay.
now we've stepped into a zone of caution.
Okay.
Returns might start to dip,
Right.
and the market gets a bit more sensitive to those gusts of wind we talked about.
Right. The tightrope is starting to sway a little
A
more.
little more, yeah.
And that's where we are now, right?
That's right.
That 4.449.
Puts us right in that proceed with caution zone.
All right. So yellow flag's waving.
Exactly.
What about beyond that? What's the next zone?
Above 4.75% is where it could get really interesting,
Okay.
and not necessarily in a good way.
Right.
Think of this as the high alert zone.
Got it.
Historically, returns actually turn negative.
Wow. Okay.
And the volatility, that's swaying on the tightrope,
Yeah.
it goes through the roof.
Okay. So 4.25 is our pay attention signal. 4.75 is hold on tight.
Yes.
But this isn't about predicting a crash.
Yeah.
Right. It's about.
It's about being informed,
Okay.
being prepared.
Right.
Like having a map of the tightrope and knowing where those windiest sections are
Right. Makes sense.
doesn't mean you're going to
Yeah.
fall,
Yeah. Yeah.
but it helps you prepare,
Right.
adjust your balance accordingly.
So it's not about panicking,
Right.
jumping off the tightrope altogether.
Exactly.
It's about knowing the terrain, making
Yeah.
informed decisions.
Absolutely.
Now, earlier, we touched on this potential Trump victory
Right.
and its influence on market sentiment.
Uh-huh.
You mentioned that the market often reacts to uncertainty
It does.
and a potential change in leadership.
Yeah.
That definitely fits the bill.
It's like the market is holding its breath a little bit,
Okay.
waiting to see what unfolds.
Can you unpack that a bit more?
Yeah.
How is the market reacting to this particular situation?
Sure. But of course.
Of course, no political endorsements.
No.
Not taking sides.
Just trying to understand how the market's seeing things.
Right.
In this case, the market seems to be reacting to the uncertainty with a bit of optimism,
Okay.
at least for now.
Short term.
Yeah. But it's really important to remember
Yeah.
that this reaction
Yeah.
could be driven more by sentiment,
Okay.
that gut feeling that investors have,
Yeah.
than by any fundamental changes in the economy.
Right. So not necessarily an endorsement,
No.
but a reflection of how the market processes change
Huh.
and uncertainty.
Yeah.
And given that we're already in this cautious zone,
Right.
this added layer
Yeah.
is definitely something to keep in mind. It's
Absolutely.
like another gust of wind. Uh-huh.
On our tightrope walk,
Is.
important to be aware of it.
Be aware. Yeah.
Factor it into our decision making.
Exactly.
So we've covered a lot of ground here,
We have.
connecting the dots between this 10-year yield, PE ratios, investor sentiment,
Yeah.
even the political landscape.
It's all connected.
It's clear that understanding the market
Yeah.
is like navigating this complex web
It is.
of all these different interconnected factors. So for our listeners who are trying to make sense of this,
Yeah.
what are the key takeaways?
Okay, when it comes to this 10-year yield,
Yeah.
the most important thing to remember
Uh-huh.
is that 4.25% level.
Right.
Like a signpost on our tightrope walk
Okay.
telling us that the risk of a pullback, that dip in prices,
Right.
increases significantly when we cross it.
And we're already past that point.
We are.
currently sitting at 4.449,
Right.
which puts us
Right in that proceed with caution zone.
we're navigating that stretch of the tightrope where the wind's picking up
Yeah.
and the swaying is getting noticeable.
So yellow flag waving. What's the next signpost we need to watch for?
The next big one
Yeah.
is 4.75%.
Okay.
If we climb above that level,
Yeah.
we're moving from caution into a zone of, well,
Okay.
heightened alert.
Got it.
That's where the data tells us average returns have actually dipped into negative territory.
Oh, wow.
And that volatility
Right.
really picks up.
So 4.25 is our first warning.
Yep.
4.75 is hold on tight.
Exactly.
But again, not predicting a crash.
Right.
It's about being
Informed, prepared.
Right.
It's like having that map of the tightrope and knowing where those windiest sections are.
Right.
Doesn't mean you're going to fall,
Yeah.
but it helps you prepare.
Okay.
Adjust your balance accordingly.
Right. It's not about getting off the tightrope altogether.
Exactly.
Okay.
Owning the terrain,
Knowing it.
making those informed decisions.
I love that. It's about being empowered
Absolutely.
with the knowledge
Yeah.
to make the best choices.
Right.
All right. So we've established this 10-year yield,
You go.
key indicator to watch.
It is.
We've identified those critical levels. But what are some other signals
Okay.
that investors can look at?
To get a fuller picture.
Yeah. A more complete picture of the market's health.
There's a whole host of other indicators
Okay.
that can provide valuable insights.
Like what?
Well, you could look at corporate earnings reports
Okay.
to see how companies are actually performing.
Yeah. Makes sense.
Strong earnings
Yeah.
can be a sign of a healthy market,
Okay.
while weak earnings
Yeah.
can suggest some trouble ahead.
So we're checking the strength of the tightrope itself
Exactly.
and making sure it can actually hold us.
You got it.
What else?
You also want to pay attention to economic data,
All right.
like inflation rates,
Yeah.
employment numbers, consumer spending,
Okay, so we're getting a sense of the overall economic environment.
That's exactly
which, of course,
Yeah.
can have a big impact
A huge impact.
on the stock market.
A strong economy can provide a tailwind for the market,
Right.
while a weak economy
Yeah.
can act like a headwind, making our tightrope walk even more challenging.
Okay, so we're watching the economic data. What else?
Another key factor is market sentiment.
Okay.
How optimistic or pessimistic investors are feeling.
Right, so we're gauging the mood.
Exactly.
We can look at things like market surveys, investor confidence indices,
Yeah.
even social media.
Yeah, you can get a sense from that too.
It's like checking the mood of the crowd,
Exactly.
watching us on this tightrope.
A supportive crowd can boost your confidence, but a nervous crowd
Yeah,
can make you even more anxious.
for sure. And we know the market is
Yeah.
driven as much by emotion
Oh, absolutely.
as logic.
Yeah, so understanding sentiment is crucial.
All right, it's starting to feel like we need a whole team to walk this tightrope. We
Yeah.
need an economist
Uh-huh. A psychologist?
yeah,
Maybe even a
to
meteorologist.
predict those gusts of wind.
Right. But even without a whole team,
Right.
individual investors can gain insight through
Absolutely.
following these indicators, doing their research.
That's right.
Speaking of research,
Okay.
we did have a listener question
Oh, good.
come in, and it's a good one.
Okay, what is it?
They're asking,
Oh,
with all this talk about risk
yeah.
and volatility,
Uh-huh.
are there any safer havens within the market? Places where investors can go to weather the potential storms?
That is a great question, and the answer is yes.
Okay, good.
There are definitely some areas of the market that are generally considered less risky.
Okay, where can we find these financial shelters?
Well, one option is to look at defensive sectors,
Okay,
industries that tend to perform relatively well even during economic downturns.
okay.
This includes things like consumer staples, healthcare, utilities.
Right, the businesses that provide the essentials.
That's right.
No matter what the economy's doing.
People still need to buy food, medicine, electricity.
Yeah. Makes sense why those might be considered safer bets.
Exactly.
What else?
You could also look at high-quality, dividend-paying stocks.
Okay.
These are companies with a long track record
Yeah.
of profitability
Mm-hmm.
and a commitment to returning profits to shareholders through regular dividends.
So even if the stock price fluctuates,
Right.
those dividend payments provide a steady stream of income.
Yeah, kind of like a safety net.
Okay, so we've got defensive sectors,
Mhm.
dividend-paying stocks, any
Yeah.
other shelters?
Of course. Don't forget about bonds,
Ah, yes.
particularly those high-quality government bonds we talked about earlier.
Right.
They might not offer the same growth potential as stocks,
Okay.
but they provide stability and predictability,
Yeah.
which can be very appealing in uncertain times.
It's like the solid ground beneath the tightrope.
Exactly.
Might not be as exciting, but it offers a sense of security when things are, a little shaky.
And within the bond market, you can diversify even further by considering different maturities. Shorter-term bonds tend to be less sensitive to interest rate changes, while longer-term bonds offer higher potential returns but also come with more risk.
So it's like choosing different lengths of rope to anchor ourselves to that solid ground.
I like that analogy.
Shorter ropes for more stability, longer ropes for maybe more reach.
Exactly.
So the key takeaway here
Yeah.
is that diversification, especially when the market's sending those warning signals, it's crucial.
It is.
Spreading your investments across different asset classes, sectors, maturities.
Right.
You can create a more resilient portfolio.
Absolutely.
One that can weather the storms.
Exactly.
So it's not about putting all our eggs in one basket.
Nope.
It's about building a strong, balanced portfolio.
A strong portfolio.
One that can handle the ups and downs of this financial tightrope walk.
Well said.
All of this is incredibly valuable information.
It is.
We've identified those levels to watch in the 10-year yield.
Right.
Explored other indicators. Uncovered some potential shelters.
Some safe havens.
So as we wrap up this part of our deep dive, anything else you want to emphasize for our listeners?
Just remember that knowledge is power. When it comes to investing.
Makes sense.
The more you understand about the market and those various indicators, the better equipped you'll be to make good decisions.
To navigate those potential storms.
Exactly.
It's about empowering ourselves with the knowledge to walk that tightrope with more confidence.
With more confidence.
And a better sense of balance.
And balance.
Now let's move on
to
the next part of our deep dive, where we'll explore some specific strategies for navigating this market environment.
Sounds good.
Okay, so quick recap.
Yeah, let's do it.
We're in this financial tightrope. We're watching the 10-year Treasury yield.
Right.
Gives us clues about the market's mood.
Yep.
2 key levels. 4.25%. Risk starts to increase. 4.75%. Hold on tight.
Things can get volatile there.
Exactly. And we're currently at
4.449.
Right in that proceed with caution zone.
Right in the thick of it.
But keeping an eye on that higher level.
Always good to be aware.
So we also talked about how this yield influences stock valuations.
Right, that ideal PE ratio.
Right, because the higher the yield, lower the ideal PE.
Yeah, and that could put downward pressure on stock prices.
Makes those bonds look a little more tempting.
Exactly.
But of course, the market doesn't always follow the rules.
It doesn't, no.
Like in 2023, we saw that positive correlation.
Right, between the yield and the market.
So it's not just about this one number.
It's a piece of the puzzle.
It's about the whole ecosystem.
Absolutely.
All those factors at play.
Yeah, those gusts of wind coming from all directions.
So we've established the 10-year yield, a key indicator.
It's a big one.
But what are some other signals investors should be watching?
For a more holistic view.
Yeah, to really understand the market's health.
Well, you could look at things like corporate earnings reports. See how companies are actually performing.
Makes sense.
Strong earnings, generally a good sign.
Right.
Weak earnings could signal some trouble.
So we're checking the strength of that tightrope.
Exactly. Making sure it can hold our weight.
Okay, what else?
You want to pay attention to economic data.
Okay, like what kind of data?
Things like inflation rates, employment numbers, consumer spending.
Right, to get a sense of the overall economic environment.
Exactly, because that can have a huge impact on the market.
A strong economy.
Yeah.
A tailwind.
Well, a weak economy can be a real headwind.
Makes that tightrope walk a lot harder. Definitely. So we're watching earnings, economic data, anything else.
Market sentiment.
Right, how are people feeling?
Exactly. Are they optimistic, pessimistic?
How do we gauge that?
You can look at market surveys, investor confidence indices.
Okay.
Even social media chatter can give you a sense.
But we're checking the mood of the crowd.
It's like that, yeah.
A supportive crowd can boost your confidence.
For sure.
But a nervous crowd.
Yeah, that can make you second guess yourself.
Definitely. And we know the market.
Yeah.
Driven by emotions as much as logic.
Absolutely. So understanding sentiment is key.
Okay. Starting to feel like we need a whole team to walk this tightrope.
It's a lot to keep track of.
Economists, psychologists, maybe a meteorologist.
To predict those gusts of wind.
But even without a whole team,
yeah,
individual investors can gain a lot of insight.
By staying informed, doing their research.
Speaking of research, we had a listener question come in.
Okay, good.
And it's a great one.
What is it?
With all this talk of risk,
Yeah.
volatility, they're wondering if there are any safer havens within the market.
Ah, places to weather the storm.
Exactly, where investors can go if things get rocky.
That's a great question, and the answer is yes.
Okay, good to know.
There are definitely some areas of the market that are generally considered less risky.
So where can investors find these financial shelters?
One option is to look at defensive sectors.
Okay, we touched on those earlier.
We did. These are the industries that tend to perform relatively well even during economic downturns.
Like consumer staples, healthcare, utilities.
Exactly.
The essentials, no matter what's happening in the economy.
People still need food, medicine, electricity.
Right. Makes sense why those would be considered safer?
Yep, they tend to be more stable.
What else?
You could also look at high-quality dividend-paying stocks.
Okay, those companies with a long track record of profitability?
Right, and they have a commitment to returning profits to shareholders through regular dividends.
So even if the stock price fluctuates, those dividend payments
can provide a steady stream of income.
Like a safety net.
Exactly.
So we've got defensive sectors, dividend-paying stocks, any other havens we can consider.
Of course, don't forget about bonds.
Right, those government bonds.
Especially those high-quality ones we talked about.
Okay, yeah.
They might not offer the same growth potential as stocks.
Okay.
But they do provide stability and predictability.
Right, that solid ground.
Exactly.
When things are shaky.
And within the bond market, you can diversify further by considering different maturities.
Oh, okay. How does that work?
Shorter-term bonds are less sensitive to interest rate changes.
Okay.
While longer-term bonds offer higher potential returns, but also come with more risk.
So it's like choosing different lengths of rope.
I like that.
To anchor ourselves.
Shorter ropes for stability, longer ropes for more reach.
Makes sense.
The key here is diversification.
Especially when the market's sending those warning signals.
Absolutely crucial.
Threading your investments.
Across different asset classes, sectors, maturities.
Create a more resilient portfolio.
One that can handle the ups and downs.
Okay, so not putting all our eggs in one basket.
Nope. Spread the risk.
Build a strong, balanced portfolio.
That can handle whatever the market throws at us.
We've identified those critical levels for the 10-year yield.
Yep.
Explored other indicators.
To get a holistic view.
And even found some potential shelters.
Those safe havens.
So as we wrap up this part of our deep dive,
yeah.
Anything else you'd like to emphasize for our listeners?
Just remember that knowledge is power.
It really is, especially when it comes to investing.
The more you understand about the market and these indicators, the better equipped you'll be.
Right, to make informed decisions.
To navigate the potential storms.
It's about empowering ourselves.
Absolutely.
With knowledge.
Yep.
To walk that tightrope.
With confidence.
Confidence and balance.
That's the goal.
All right, let's move on to the next part of our deep dive.
Okay, sounds good.
Where we'll explore some specific strategies for navigating this market environment.
Alrighty.
All right, so we've laid the groundwork, understanding the 10-year yield, those key levels, even brainstorm some potential safe havens.
Yeah, we've covered a lot.
But let's get practical.
Yeah, let's do it.
For our listeners who are maybe feeling that wind pick up on their own financial tightrope.
Right, seeing those warning signs.
What are some strategies they can use?
To navigate this environment.
What can they actually do?
The first thing I'd say is don't panic.
Okay, good advice.
Remember, we're talking about potential risks, not guaranteed outcomes. The market, it's constantly evolving.
It is.
Even when those signs are flashing.
Yeah.
There's still opportunities out there.
So we're not saying jump off the tightrope.
No. Adjust your balance.
Right.
Maybe take smaller steps.
Okay. So with that in mind.
Yeah.
What are some strategies?
A few things you can consider.
All right.
One is to rebalance your portfolio.
Okay.
If you're feeling overexposed to stocks, now might be a good time to shift some assets into those safer havens we talked about.
Right. Like
bonds, defensive sectors.
Okay.
Helps reduce your overall risk.
So we're adjusting the weight distribution.
Exactly.
On that tightrope.
Make sure we're not leaning too far in one direction.
Okay. What else?
Another strategy is to really focus on quality.
Okay.
Especially in uncertain times.
Yeah.
It's more important than ever.
Yeah.
To invest in companies with strong fundamentals.
Right.
Solid earnings, proven track record.
Okay.
These are the businesses that can weather the storms.
So the tightrope itself is made of sturdy material.
Exactly.
Can withstand those gusts of wind.
Absolutely.
Makes sense.
And don't forget about diversification.
Right. We talked about that.
We did. but it's worth repeating.
Yeah, spread those investments
Across different asset classes, sectors, geographies.
Okay.
Reduce your exposure to any one particular risk.
It's like having multiple safety harnesses.
Exactly. If one fails, the others are there.
Okay, that's a good visual.
And finally,
Yeah.
don't be afraid to seek professional advice.
Okay.
If you're feeling overwhelmed
Right.
or unsure about how to navigate all of this,
Makes sense.
a financial advisor can provide personalized guidance,
Okay.
help you develop a strategy that aligns with your goals.
So it's like having a seasoned tightrope walker by our side.
Exactly. Someone to offer tips and support.
Fantastic advice.
I hope so.
We've given our listeners a lot to think about.
Yeah, hopefully some actionable steps.
So as we wrap up this deep dive,
Yeah.
what's the one message you want to leave them with?
Stay informed.
Okay.
Stay adaptable.
Yeah,
And don't let fear paralyze you.
I like that.
Even in challenging markets,
Yeah,
there are opportunities out there.
for those who are prepared.
Exactly.
Couldn't agree more.
It's about staying balanced, staying informed.
Eyes on the prize.
Well said.
This has been incredibly insightful.
It's been a pleasure.
Thank you for sharing your expertise.
My pleasure.
And to our listeners,
Yeah.
we hope you found this valuable.
I hope so too.
Remember, it's not about specific investment recommendations.
Right.
It's about giving you the knowledge
The tools.
to make your own informed decisions.
That's the goal.
So until our next deep dive,
Until next time.
stay curious, stay informed, and keep those safety harnesses securely fastened.
We'll see you on the tightrope.
See you next time.